Stocks at session highs pretty much, just off them a fraction, but still up nearly 300 points on the Dow, up nearly 2% on the NASDAQ. And Josh Brown, is this the market saying that rate hikes actually won't matter to market levels as long as it's well telegraphed?
I think maybe there's some element of that. I think a lot of people put on some hedges that maybe you're going to get unwound. Maybe there was like a minority view at the margin that there was going to be some sort of a shock or some sort of uber hawkish tone, which, I mean, for me, that would have been a very easy bet to fade. I've been saying since the summer that the taper, when it comes, will be seen as a relief. We deal with over 1,000 high net worth households at our wealth management firm, many of whom are small business owners or executives at mid-sized companies. Not one person I've spoken to this year feels that we should still be doing emergency stimulus. In fact, if you look at areas like the housing market, it's been counterproductive. Sticker shock on homes actually slowing the number of transactions. So nobody wants to see more of this. It's good that it's coming to an end. I would point out that on a net basis, we are still adding liquidity to the system. We're just doing so more slowly than we were. So to me, that's still outrageous, but I understand this has to take place in a progression. Big picture, it's a very weird bounce today. It's respectable, but it seems to be very defensive. You look at Staples ripping to all-time highs, McDonald's, Pepsi, Coke. You look at Costco, which I would consider to be defensive. XLU, which is the utilities, making a 52-week high. Healthcare making an all-time high, also defensive. So that's not a bad thing. I'm just pointing it out. It doesn't look like people are like getting all bulled up on the economy. But we'll take it. Apple obviously is adding a lot of strength here, up another 2%, getting back to that record high. So that's where we are. It's a good thing. It's not a bad thing. But overall, I think most of what we're seeing here is not a renewed exuberance. I think it's just people saying, okay, the comet missed Earth again. Great news.
Right. Lizanne, do you share that view that this continued rotation into some of these defensive sectors signals that perhaps that some parts of the economy will keep growing, but that there is some pause being taken with the outlook on inflation specifically and what's around the corner from here?
To some degree, yes, but you have to remember, and I agree with Josh about positioning sometimes can skew what happens in the very short term, and I think there probably was a lot of defensive positioning coming into this. In fact, pre-Fed meeting, at least on the day, utilities were leading, and then you saw tech jump in front. If you also look at some of the spec areas in the market, heavily shorted, non-profitable tech, those pop too. So there is, I think, some shorter-term money that, for now anyway, is going back into these spec trades. However, these sector shifts that we are seeing and have really been seeing all year have been unbelievably rapid fire. And I think that that's likely to be a pattern that will continue. And it's not always the same theme of defensive sectors versus growthier sectors. It's not really growth versus value. It's not really reopening versus shutdown. Each leadership shift, I think, has different drivers. Sometimes it's an inflation driver. Sometimes it's a yield driver. Sometimes it's a variant driver. And I think that that is likely to persist. I think trying to sort of game it ahead of time, these short-term shifts, I think is a bit of a fool's errand. I think probably the best strategy in an environment like this is maybe up the pace of rebalancing to take advantage of sometimes the huge gifts of profits that are handed to you in a very short period of time. I think that kind of rotation is likely to continue as we head at least into the beginning of next year.
And Lizanne, with that in mind, as you're doing that rebalancing, overall, do you want your clients to remain pretty much fully invested?
Well, we are what we would call neutral to U.S. equities right now, which effectively means, yes, stay at your normal allocation, and that's going to vary depending on where you sit on the risk spectrum, et cetera. So, yeah, we're not making either an outperform or an overweight call or an underweight call, but in the context of kind of hugging to neutral, I think the rebalancing strategy, having it be more portfolio-based perhaps versus, say, calendar-based, gives you a little bit of edge and allows you to stay in gear without having to try to time some of these short-term shifts. So for now, anyway, that's been the strategy we've been recommending to our clients.
Yeah, short-term shifts, weeks in the making. We'll see what happens from here. Lizanne, we always appreciate your perspective. Thank you so much for joining us.